What up, people? I'll tell you what's not up. Ranger hockey right now. Getting shut out by the Islanders last night. Not good. No bueno. We'll talk about that later. 30 minutes because I got a 5,000 on Thursdays, as you know. Guy Adami here. That's Dan Nathan. It is Thursday, October 27th. The month went by like that. EY from SoFi in just a few minutes. She's waiting in the wings with a new microphone, by the way, and she's pulling some serious stuff on this week's writings, her musings. Today's episode, Dan, brought to you by FactSet, financial data and analytics that are powered by tomorrow, Dan. SoFi, get your money right all in one app. Please don't clear your throat while I'm doing my read. And our production partners, Open Exchange. I am so geeked up on Mountain Dew. How you doing?
I'm doing great. I think your mic is a little hot here, Guy. We're going to have to turn that down a little bit.
Okay, I'm going to do it right now.
Yeah, no, there you go. Why not? It's live here. Let's do it. All right, let's kind of get into this because, tonight after the close, this is the big one. We've had three very, very disappointing major tech earnings this week. We don't really need to kind of go into greater detail about what we heard from Microsoft and Alphabet earlier in the week, but the fact that they've followed through, Guy, today to the downside, both down 2%. Spotify was also down a lot. So Amazon and Apple after the close, we're going to get into that a little greater. I just do think if you look at the follow through to the downside with Meta now down, 22%, just so you know, I bought a little at 101. I really feel like, listen, here's the deal. We all know that this company was about to be $1 trillion market cap. And for some reason, Mark Zuckerberg decided to kind of plant, I don't know what the hell you want to say, seed or whatever kind of flag into the ground about a year ago, changed the name, changed the direction. Listen, we knew there were major headwinds for this company firing on all cylinders, let's say, in mid-2021. But from a regulatory standpoint, from a competitive standpoint with TikTok, from from just what was going to be a secular maybe headwind after a couple really great years of digital ad sales. But this stock, Guy, down 70%, is truly amazing. Now, the question I have for you, would you bet against this company right now, 300 to 100 in less than a year, given what they've said about how they have to figure out how to better monetize the 2 billion people that log on every day and the 3 billion that log on every month?
Yeah, so that's, as we say, a rhetorical question. I like that word because it sounds like I'm smart when I say it and has an H after the R, those two reasons. And you know the answer. The short answer is no. And, I think we've done a decent job in illustrating how something like this could happen. So here we are at levels we effectively haven't seen, I want to say, in 6 or so years, maybe longer than that. Doesn't matter. Point is, as I've mentioned, we're going to have a capitulation day on volume. Doesn't mean the stock's going up 20% tomorrow, but you've effectively flushed a lot of people out. And what I said on Fast Money last night, and I'll say it here, you might not think you own Facebook, but quite frankly, there's a very good chance that you do if you're in the market, being in 322 or so ETFs. And I said this last night. You think about what Facebook has screwed up, and it's a lot. They changed their name, no good. They basically got into a business that nobody understands and they can't cogently explain. They bought back, Dan, $42 billion with a B worth of stock at an average price of 300, which means they're lousy stock traders. So effectively, they've done nothing right now since the name change, and the stock is being punished on the back of it. To your point, though, when you have 35% of the world's population effectively on your platform, somebody's going to figure out how to monetize that. So to me, today is your capitulation day. It doesn't mean it's going to bounce. This is what you've been waiting for literally for the last 8 or 9 months, and it's being handed to you, I think, on a silver platter.
Yeah, no, I agree. And again, we've been talking about trading a bunch of these names like Snap, like Nike, that have had huge gaps to the downside, even when sentiment was really poor and the stocks were acting very poorly. There's ways to kind of trade around these things and take advantage of just some of the just extreme sort of selling we're seeing. This is kind of hate selling. All that being said, a stock that's down 70% can get cut in half again, and so you want to be nimble here a little bit. Guy, one of the silver linings things I thought was kind of interesting, at least investors thought, was that CapEx they're going to continue to spend. It's going to be hardware driven. It's going to be heavy graphics. You saw that Nvidia gapped up 7% this morning. It's only up about 3% right now. Look at the downtrend that this has been. We've talked about it a lot. It does really feel like they're not going to report for a few weeks. That this one, again, maybe you get to that kind of upper bound of that downtrend, but there's a lot of room to the downside. And then you back this thing out, 5 years, and you see the levels that it just bounced off of. Huge support level. Again, we don't have to draw any other lines on this thing. Thoughts here, because Nvidia still expensive in a market where investors don't seem to be that inclined to overpay from a multiple standpoint for some growth names.
Well, we've said for a while, Nvidia is an extraordinarily important company. It's a great company, and don't confuse the stock performance with the viability of the company. Again, you've said this on the show, and it's going to sound glib. It's not meant to be. It wasn't Nvidia's fault that the market bid it up to levels that it should never been at the first place. But here we are now. So now everybody will sort of cast aspersions and say what allows it. It's not. It's a very good company. It's just a very expensive company. To your point, we're at the upper end of this downtrend. Reports in a couple of weeks. It stands to reason, given what we've heard from a number of competitors, that it's probably going to test the lower end of that bound. And you would put us at levels we haven't seen in many years, and that's your support. And when you talk about this, a company like that, if it trades at 4 or 5 times revenue, then you're talking about something that's extraordinarily reasonable, as opposed to probably the 30 times or so it traded at its peak.
Yeah, all right. And then it's not all disasters in the stock market today on earnings. And when you look at a few names here, this one's really interesting, guy. ServiceNow, back in July, I think it was 12th, prior to the Q3, Q2 earnings cycle. CEO of this company, it's an enterprise software company, a SaaS company here, talked about weakening demand. The stock had a huge gap lower. You can see it on the chart. But here we are today. The company reported stock gapped higher. It gapped to that point where it was in July. Interesting, when it sold off kind of hard here. But one of the things I think is interesting when you think about how poorly this stock was acting into the print, they had kind of I guess given the warning that they are going to see weakness in enterprise. We're starting to see that right now in these earnings reports. So sometimes it's just where you are in the cycle and how quick your management is to kind of identify some of the trends that we're seeing. That is why Microsoft is down again today, because I think a lot of investors were really holding on and thinking maybe that some of their divisions were going to kind of, not really fall victim to some of the trends that, say, a ServiceNow was seeing earlier in the summer.
It's interesting. The move to if the first move lower was on the back of the guide, we actually talked about it. You brought it up. You actually said how important it was, and you were surprised nobody was talking more about ServiceNow. Not the company itself, but the read through. Subsequently, the stock bounced and was getting higher than where we broke down from, and then it collapsed again. So to your point, here we are at levels that we traded up to, and seemingly we're going to, I think, exhaust ourselves on big volume. Bill McDermott, the CEO of ServiceNow, came from SAP. The guy is very good at what he does. But to your point, what are the read-throughs on the back of this? So this is company, again, I think it's a great company. The stock is not a great stock. And I think if you've been so fortunate to own it into this number, I think you're taking profits and looking for another downdraft. But that's just me. And some of these other companies in their world are basically telegraphing exactly that.
Yeah, here was one yesterday. I just thought Carter's, bearish to bullish reversal, he kind of laid out in Robinhood and Roblox and in Toast. Here is one that he could have had on there. And this is a stock that I actually have traded a couple times over the course of the summer, and it's Shopify. And this would have fit right into that whole little, what do you call it, a pastiche that he was doing or something like that? Yeah,
pastiche.
Yeah. Like so look at this one. We didn't even draw any lines. There's the 200-day moving average. I was not long into the print. I will tell you this, earlier in the month, I bought it near $26 and I sold it just over 30. That's a pretty good trade, in my opinion, as I try to pat myself on the back here a little bit. But I'm also here to tell you that I'm kind of annoyed at myself because I'm not here for this kind of 15% move. And at the end of the day, okay, this is a company that is not profitable right now. But, look at this thing here. It's pretty bombed out. And you could see this thing trading up to that 200-day moving average guy in a better better market very easily, which would also get you back, just, I guess, above those August highs. I'm looking to rebuy this thing on any sort of pullback.
That's right. That's the way you play it. I mean, you have this you probably have 4.5, 5 months of just a flattening, bottoming out process, and then it's going to resolve itself, I think. And I think if Carter were here, he would say the same thing with a move to that moving average. And then again, you have to make a determination. We will beat ourselves up from time to time, but as it turns out, unless you have proprietary trading platforms with Seeker on the back of it, nobody buys the low and sells the high. It's just the way it works, Dan.
Yeah, that's a fact.
Well, I'm just saying.
I know, Guy Adami. All right, here's two.
By the way, I know you want to move, but the Seeker by The Who is one of my top 5 Who songs.
Fair enough, and it's probably on your Spotify playlist of how many songs?
805.
There you go. You guys can find him at Guy Adami on the Spotify. All right, here's two guys that I think are really interesting. We talk about all of this technical weakness that's been in the stock market, despite the fact that the S&P is down about 20%. There's been a lot of stocks that are just so far below their 200-day moving average. Here's a couple that are up today, reported better than expected results. Look at this McDonald's here. It's breaking back to levels from, I want to say late August or so, well above its 200-day moving average, and then Tractor guy, it really stopped to the penny yesterday prior to this morning's print, right at its 200-day moving average. That's a big gap in an industrial there. So again, talk to me about these two names, and these are two bright spots, I think, in this earnings period.
I'm glad. See, they toggled back without me saying it. So let's look at McDonald's first. So we have been bullish on McDonald's. If you watch Fast Money, it probably trades expensive to the broader market. It's probably in line with where it trades historically. How do you trade the stock now? Well, I think this might exhaust itself at those levels. If you look to the far left of that chart, we're going to trade up and test to that prior high. I think it probably fails there and does a back and fill. So again, this is one of those names, if you've enjoyed the ride, today's the day you've been waiting for. I think it's prudent to take profits. And if you look at Caterpillar, I'm going to say a very similar thing. Gaps like that are meant to be filled. Now, we are effectively filling a gap. If you go back to the middle of the chart when we downdrafted, we are now filling that gap. It stands to reason at a certain point, and Carter will speak to this, that the gap we've just created will be filled again. So maybe this has another couple days in it, because I think people probably got themselves completely off sides in Caterpillar, but it will exhaust itself, and it'll probably exhaust itself another 6 or 7% from where we are. And then you're looking for a move back down to that moving average, which, by the way, Dan, is still sloping lower.
That is a fact. All right, let's look at the two big ones that are reporting tonight after the close. Apple is one of them. It is the one. Okay. And here's one of the things I think is really interesting. Again, you and I, we don't have to spend a lot of time on this, given what we've heard from Google, from Microsoft, some of the issues as far as supply chains with China, manufacturing, demand in a place like China, demand in Europe, all the above. We know that Apple had these new phones. We know that they have some pretty good devices. I love this Apple Ultra watch. It's pretty dope, as the kids say here, Guy. But listen, on a number that's not as bad as expected, and guidance is not as bad as expected, I just don't see this thing trading much higher than its 200-day moving average, which is right there, 156, 157, the implied move again, about 5%. That would get you there. But look at this thing, backing it out a few years here, Guy. Look at this uptrend that's been in place from that late 2020 gap here. On the downside, man, if they were to miss and guide lower, it's going to blow through that. Thoughts on Apple into the print?
I don't think anybody thinks that's going to happen, which is why there's potential for that to happen. Again, and please don't, I'm not interested in being added on Twitter. It really just exhausts me. But I will say this, if you didn't know this was Apple and just looked at that chart, and then I would tell you this is a company that trades north of a market multiple, probably trading around 22 times or so next year's numbers, trades with mid to low single-digit EPS and revenue growth, and it has declining margins. And they sell things that are not cheap, Dan, in an environment where people are probably looking to ratchet things back. I mean, I don't know if that's necessarily a stock you want to be in, and I understand that it's Apple. On top of that, think about what's going on between the U.S. and China. We've talked about it on the tape, on Market Call. We mentioned it on Fast Money the other night. That situation is only going to escalate. It's not going to resolve itself. And I will tell you, the existential risk for Apple, and there's probably a 15 to 20% chance that happens, is the Chinese decide to put a huge bullseye on their back. And then we're talking about a whole different ballgame. So, again, I'm not a hater. I mean, I'm not a lover either. I'm not one of these people that bow at the altar of Apple or wait on frickin' line like some people do for hours to buy some shitty phone you can buy on the line. Back to you.
Oh, wow. Guy Adami,
well,
man.
I mean, it's true. You know what? Now I'm getting myself, I don't know why I do this to myself. I really don't know, because I was in such a good mood. But if you're waiting on, if you find yourself at any point in your life waiting online at Apple for anything, reevaluate everything that you're doing. Back to you, Dan.
Fair enough. All right, let's look at Amazon here. And this one, is interesting to me, not just because it's maybe a read on the U.S. consumer, a read on spending from their, just all of the activity that they did building out logistics. We know that they're looking to kind of pare down headcount and kind of offload some of these distribution centers. I mean, the list goes on and on of the things that you want to be focused on. Obviously, dollar strength. But the other one is that they've built a really big advertising business too, Guy. And this might be a read. I think they have over $30 billion in ad sales annually. So again, given what we've heard from Google and Facebook and Snap, that's something to keep an eye on. That downtrend, obviously a series of lower highs. You see that 200-day moving average at 132. It really feels like that support level just above 100. If you back that thing out, Guy, look at this thing, man. Going back 5 years, that 104 level, that is a massive level. Let's see if it trades down. The implied move is about 8%. That would get you down towards those support levels. Let's see if it holds. Why did we start this whole segment about the follow through to the downside that we're starting to see in some of these mega caps? It really is that people are overloaded in those names, and we're seeing a bit of rotation. Maybe that's one of the reasons why we're going to talk about small caps with Liz. Maybe we're seeing good relative strength in some of these down names and the, and obviously the small caps here. So thoughts on Amazon into the print, how you might be trading this?
It's remarkable how well the market's hung in on the back of everything we just discussed. I mean, I think it speaks to maybe some of the things we said a week and a half, 2 weeks ago, the fact that we're in this rally in a bear market and we could probably go up about 15%. So the fact that the market's hanging in there is pretty impressive, number one. Number two, their prior CEO, I'm sure you're familiar with that gentleman, but basically, and I'm not a nautical person. I know EY grew up in the Midwest. Maybe she spent some time on Lake Michigan or something, but he said, time to batten down the hatches. Now, Again, I don't know if I have any hatches in my house, and I wouldn't know how to batten them if I did, but he's basically sending a bit of a message, and you have to wonder, what can Amazon possibly say in this environment that's going to get the stock up that 8%? So I actually think you're going to see a downdraft here. And the trend in Amazon over the last many quarters, one up, one down, but when they move, it moves violently. You saw the violent move to the up. I mean, this is a stock that rallied almost 70% at one point, if you think about it, and we're right back down to these levels, which is remarkable. So I'm looking for a better entry point. I think you're going to get it, Dan.
Yeah, and I'll just say this. I'm not playing any of these names individually right now. Not this week. I did with Snap, and I did have a small position into it, and I traded in and around it after it had that big gap. Amazon, Google, should it have been bought this morning at 90? I don't know. Maybe. Microsoft, maybe the level was 210. It didn't get there yet. Apple, you tell me if it get back towards those lows, that we saw, which was down there in, the 120s or something like that. I just have one small trade on, and it's long QQQ puts, and they're weeklies, and I don't recommend that people trade weeklies in something like an index, because if you get the direction wrong, let's say in a put strike above your strike by a penny, they're worthless in a day. That seems like a little punty, as the kids would say, right? But to me, I think there's a chance that Apple does miss, guide down, Amazon may be the same. You have a NASDAQ gap down again, and maybe that's the thing. That's the opportunity to kind of buy the market into next week's Fed meeting. Thoughts on that strategy, Guy?
No, I think that's right. I think your timing. Listen, this is where you have to thread the needle. But I'll say this in terms of how the market shakes out. We said it a week and a half or so ago. It felt to me as if we were in a very similar situation as we found ourselves in mid-June. And then subsequently, the market rallied almost 19% into mid-August. And then obviously, we had that huge downdraft. I don't think we're going to have that magnitude of a rally. I think it's going to be closer to 14.5%, 15%. And if you start doing the math off at 34.91, it puts us a little bit north of 4,000. So that's another, 170-ish handles in the S&P. It all sort of lines up to me, gets us into the midterm election probably, and then post-election, all bets are off, because I think some really weird things are going to happen after that, Dan.
All right, so Guy, this is probably, I think, the probably most exciting moment of the week for you on Market Call. No, let's do. Well, that's the second most. Okay, let's save Butters for Liz.
I mean,
so this is LY.
Can I do it? Am I allowed to do it?
Yep.
So first of all, I want people to understand when I make fun of EY from SoFi, I do it out of love, because think about it. If all the things I said were true, it would be mean, and I wouldn't be saying them. So there is a sincere affection there. Just number one. Number two, your note today, I mean, you went deep with this one, and I'm looking forward to it. But without further ado, which is a French word with an I-E and a U, it's EY from SoFi.
Hi, guys. Look at this fancy mic.
Well, yeah, you sound great, LY. Hey, here's the deal, LY. You just heard us talk a little bit about all these mega cap tech earnings. Thoughts on that? Because again, so far just this week, the ones that we're most focused on, this is before we get Apple and Amazon tonight, they're not good, and they're massive moves in market cap terms. And so, just give us some sense of like how you're thinking about this relative to maybe some of these non-tech names. They're kind of holding in there a little bit.
Well, so first of all, it's about time, right? It's about time that we started to get the news that tech companies were under pressure, that their margins were under pressure. There's been a point made, it's been made a couple times in the last few days, that these tech companies, and if we just take Silicon Valley as a whole, okay, they're younger in general than a lot of the more established industrial companies or the companies that have been around for a very long time, such as McDonald's, which is my favorite fast food joint. But they're not used to this. They haven't been through cycles like this, and they're not good at cutting the fat. So we're at this point now where we've seen the headwinds coming. We've seen these advertising headwinds coming. Now we've got a need for cost control, and they're not doing great at it. So obviously, all of these tech companies are very different from one another, and where they get their revenue from is very different from one another. The thing that I would say to investors, and we've been talking about this on Market Call, and I know I've been talking about it on CNBC a lot, is that when you have quarters like this and years like this, where revenue growth is beating EPS growth by so much, and it's happening because of inflation, guess what happens when inflation goes down? You don't have the buffer anymore. You don't have the margin. And when that margin disappears, they're going to be in a world of hurt. So I would say it's about time that we're getting some of this bad news. And we all know that as tech stocks go, the market goes, because they're 26% or so of the index. So I think that this is good for us to go through as an exercise. I think it also says that this rally is a little irrational in this moment.
Well, that's a good segue, Liz, because, John Butters, our friend over there at FactSet, he writes the Earnings Insight blog. It drops every Friday on FactSet. He gives us a nice little preview of what he's going to be publishing tomorrow. And when you think about this, we've talked about energy and just the outperformance this year. His note tomorrow is going to talk about the sector and its contribution as far as earnings to the S&P 500. And here's the deal: the highest year-over-year earnings growth of all 11 sectors in the S&P 500 at 117%. That's the energy sector. This sector is the largest contributor to earnings growth for the index for Q3. X-energy, the S&P 500 is reporting an earnings decline of nearly 6% for Q3. This will mark the second straight quarter of year-over-year earnings decline for the index X-energy. Guy, when you start hearing things like that, X-energy, what does it make you think? Because Liz said it's about time for mega cap tech. I'm just curious how you want to think about Butters' work this week.
Well, it makes me think of a few things. I think we've done a great job navigating the energy trade. I think you've done a fantastic job on the commodity front. I think we've collectively done a great job on the stock front. I mean, you look what those names have done. And what do I hear? X-energy? Well, I just hear Fed speak in my head, which makes me crazy. I'll say this, though, quickly. 2 quarters of declining growth, Dan. What does that sound like to you? Oh, I'll answer for you. An earnings recession. Where did you hear that many months ago, Dan Nathan? I'll wait for the answer.
Market call, MRKT call.
Yeah, you did. So that's what I think of. I mean, again, I'm not an economist. I have no freaking idea. But what I've said for a while is that we're definitely in an earnings recession, and it's playing out right before our very eyes.
All right, Liz, talk to us, though, because I thought the last point on this note was really interesting, that in Q2 of 2023, the energy sector is predicted to be a detractor from earnings growth for the index. So a little bit of runway for energy to help out the S&P between now and mid next year. Talk to us when you see data like that.
Well, when something's driven by just one sector, I mean, if you're an investor who got into the market post-COVID, you've been taught that concentration works. And if you're concentrated in energy right now, you've probably been doing pretty well, but nobody is. So we're going to get to the point where I think the timing of this is going to be really tough for investors. We're going to look at it and say, oh, wait, energy is still the best sector in the index. That's when I buy it. And then everybody plows in and they stop contributing on earnings. Here's what I would say about the timing. And look, none of us are going to time the market perfectly, but if we just play out what the signals are telling us right now. So signals like yield curve inversions, all the other stuff, PMIs getting almost to contraction territory, new orders in contraction territory, all the things that tell us a recession is coming. If we assume that it starts in the first quarter of 2023, there's a chance that this earnings recession has played itself out by the end of the fourth quarter and through the first quarter, and then other sectors can come in and contribute again. We might be slowly out of the woods, and then the market can find its footing on the other side with other sectors.
Yeah. All right. Well, thanks to Butters. We appreciate that. That's good kind of food for thought here as we're getting to the backside of S&P earnings. But, Guy, let's look at this S&P 500 chart again. You have been saying this for a couple weeks now. You think we could have a counter trend rally. You remain bearish of the S&P 500. We're starting to see a lot of pieces come together. We're starting to see estimates come down both by the sell side and investors, but also the companies ratcheting down that guidance. You see this series of lower highs in the S&P 500. You have that declining 200-day moving average up there at 4117, just below that downtrend. We're probably 10% off of the lows. Guy, are we going to get to 4100? And then obviously I know that you and I both remain bearish of the markets. We don't think this is how we bottom here. You'd probably be a seller with both hands up at those levels.
Yeah, and I'm not certain we're going to get there. And with each passing day, the time decay on that line takes that lower and lower. But we have said since effectively October 13th, 14th, that, again, the environment's set up eerily similar to what we saw in June. I don't think we're going to have that magnitude of a rally that was closer to 19%. And maybe I'm being too cute here or too tactical. And maybe the time is to sort of take some chips off the table now. But the relative strength of the broader market on the back of everything we've talked about for the last now 27 minutes is pretty remarkable. So I'm going to hold out hope that this rally has a few more days in it into probably the midterm. But again, I think you have to have this on an extraordinarily short leash because I do think 3,400 is a foregone conclusion. All
right. So Liz, quick question. You were out with the Risk Reversal Media team the other night here. Huh? And you got you were invited, Guy. You just didn't show. And Liz sat next to Stephen Rafis. He was Johnny on the spot with all the charts.
Rafis is going to be a first team all-star for the PLL next year.
You think so? The PLL Cannons. He had a little bit of a sophomore slump. We've been talking about it this year. But I challenged him this morning because he's Johnny on the spot with these FactSet charts here. And look at this one here. This is the 5-year of the S&P 500. I don't think he could do it, but he did it. Look at this beauty right here, Guy. You see, it looks like a chart that Carter did here. It's this beautiful uptrend from the lows of COVID, but now the downtrend that we've been in here. And if you look at, Liz, look at this, that support level that we have down there, the pre-pandemic high, 3430. We almost got there in that downdraft. Yeah. Thoughts on the S&P here? Do you think that we've bottomed here? A lot of people want to call bottoms here. We're not ones to do that here on the market call. Thoughts on the S&P here? Because again, I mean, that downtrend is pretty well defined. If we had, I don't know, another week or two, like Guy says, maybe you get to 4,100. Would you be a seller at that level?
All right, here's what I would say. Obviously, I'm not going to try to call the bottom. Everybody loves trying to call the bottom when we're 5 to 10% into a new rally, because then it looks like it's in the rearview mirror and, there we did it, it's done, it's over. That might be a bottom, sure, when we look back on this period. I don't know if we're going to make a new bottom or something that's drastically lower. Nobody knows the real answer to that. Before this rally started, I did feel like we would get closer to 30% down on the S&P from peak to trough, which is below where we were before. So it's 33.57 on the S&P to be exact. That would take us down 30%. And the reason I felt like we would get there is because I feel pretty certain now that a recession is coming, no matter how mild. So the market needs to price that in. The market is still not sold on that. So I do feel like we probably rally a little bit here. It's an opportunity to take a little bit of a gain in names that maybe you wished you would have exited before. Okay. Yeah. So things that I would exit, not that any of these are up dramatically, but things that I would exit are some of those high growth names, tech names, right? Because I don't think that those are the ones that are going to get us out of this on the other side. So I would start to look at your positions, and my piece today talks about this a little bit too. Look at your positions, make sure that your portfolio looks like you want it to for the period right before a recession, during a recession, but more importantly, the period afterwards, because that's the longer one, and that's the one that as an investor is going to make you some hay.
Yeah. So real quickly on yields, you just mentioned them here. We have the 10-year yield, and we're at a pretty crucial, I think, technical level here, Guy. We've been talking about that steep uptrend. We look at that breakout level from just a month and a half ago, up there at 3.5%. We're at 3.95 right now. I mean, listen, this thing could be 3.5 in the not so distant future. And I guess the question would be, yes, we've talked about the 2-year, more reflective of what the Fed is going to do with Fed funds, but is the rolling over, or maybe the breaking of this uptrend, is it reflective of the fact that the Fed might be done or slow the pace after the December meeting of their rate hikes? And then also, is it also reflective of just slower growth?
Yeah, all the above, and I'm not trying to be glib, but that's exactly right. I think there's a hope that the Fed is going to signal a pause, or they're going to be more data dependent, and we've done our job. Let's take a look at things. I think there's also a concern that things are slowing down without question. It also probably is on the back of a market that people are looking for a flight to quality. And I think you're finding it in the form of bonds. So those things are lining up. And that also coincides with the dollar actually going lower today, notwithstanding. So this all makes sense to me. But I would submit quickly that if you do see yields go lower, you're going to see it maybe in the 10-year. You'll see it in the 2-year, but not nearly to the magnitude. And if you get to 3.5% in the 10-year, you're probably talking about an inverted yield curve to the tune of about 75 or so basis points. That's just my view. Now, as we go to EY's note, and I love this, by the way, because I actually went to school with this cat. I want to mention the ombre thing you got going on right now is fantastic. Number one, just pointing that out. And the fact that I know that is wonderful. But, I mean, Macbeth 1623, I believe, when Bill wrote it, obviously speaks about Macbeth, some Scottish dude. He finds his way into a cave, meets 3 witches, and this is what we're going with here, this double toil and trouble, which, by the way, I totally dig. So take it away, EY.
So we're calling Shakespeare Bill now.
Yeah, well, that's what I call him.
At some point, you have to put the camera back on me because I brought a prop.
No, you didn't.
I did.
Did you bring a cauldron, I hope?
It's a Halloween-themed
That's
home,
so good.
So
that is fantastic.
Got a little pumpkin. Okay, so here's the thing. I'm not a big lover of Halloween, but I love all the stories and the stuff around it. And this was on purpose. I knew that this was going to release on GDP Day. And I knew that this was going to release on GDP Day when we'd probably have a positive GDP print. So people are going to look at me like, you're nuts. Why are you talking about a recession on the day that we came out of one? Because I don't think it's over. And we've talked about this so many times. I'm going to use a tornado analogy. Those of you who've heard this before will remember it well. In Wisconsin, we had tornadoes. We never had hurricanes. A tornado watch was when the conditions were present for a tornado to form. A tornado warning was when one had been spotted in the vicinity. I would argue that what we saw earlier in the year, yes, defines a recession. We're still in just a warning phase, though, because it didn't reset the business cycle. A recession will reset the business cycle, take care of inflation. We start all over again. So think about that from business school. Those of you who went or those of you who didn't, you're getting a class in it right now. You go to late phase, you go into a recession, then you go back to early phase. We are not in early phase right now. So I still think we need another one to actually get back into early phase. So we looked at what do different asset classes do 6 months before, during the recession, and then 6 months after, because I think it's getting closer and closer. So like I said before, if we go into a recession, let's say first quarter, second quarter of next year, the market likely tells us that first. So you want to start entering these sorts of positions, things like small caps, things like cyclicals. It's not technology, okay? It's not the big growthy names. I'm not going to use the value term because I think that doesn't really work anymore. But you want to think about different sectors, and you want to think about getting out of some of those mega cap names, or at least averaging out of them, so that you're not oversized on the stuff that is not going to keep up.
Oversized. That's going to be. Listen, you know what? It's funny, Liz, and I love you to death. I kind of feel. I think you want to start averaging into the mega cap techs in the not so distant future, but that's more my orientation. Do you know what I'm saying? Like that's kind of the areas that I feel most comfortable with, and I also think that there's some unusual values. I've heard a lot of very smart strategists say some similar things that the stuff that led us in the bull market is not going to lead us in the next. I just don't believe that's the case. And what's different this time is the absolute size of these 4 or 5 companies and the moats that they have and the management and the monopolies of their products. So to me, it's just very different. Now, all that being said, you could look at me and say, Dan, you're the dumbest guy that I know in the markets. And if you watch Fast Money for the last 10 years, I probably backed that up here and there. Look at Meta. It was going to be $1 trillion market cap company owning the space and they're in. And now the narrative is that it's going the way of MySpace. Okay. I just bought some stock there. I don't believe that's going to be the case. But again, that's why I could be very wrong on this. I want to start averaging in a big way in the QQQ, maybe starting at 260 or so, all the way down to 250, 240 or something. So that's my trade on the way out. By the way,
no, go ahead, EY.
I was just going to say, I don't think you're the dumbest guy in the market.
Yeah,
it's not that you don't want to be in tech at all. And I would say, here's the reason. If we're going to talk about it broadly as a sector, I think in this environment and for the next few quarters of this environment, valuations matter so much. And investors finally got smart to the fact that they have to decide how much they're willing to pay for future growth. And a lot of these companies, if they can't control their costs, don't have a ton of future growth that looks very solid. So at that point, you're not willing to pay much for that growth anymore. Now, if they get it together and if things get re-rated and rates fall again, it's a different story. You want to have an allocation to tech. I just think there are so many investors who, much like you, are very comfortable in that space and are completely overweight it. And FYI, if you're an investor and you have an ETF, a broad market ETF, and you own the FANG names individually, you're overweight. You're way overweight.
Yep.
So you have to think about that. And I just want people to think about some of the sectors that are lesser owned, less exciting. I'm not looking at defensives right now, but I would look at cyclicals. And we all know that my favorite cyclical sector is financials.
In this episode, we learned about ombre, which I loved, rhetorical. A lot of words we seldom use here on Market Call. By the way, Dan, the word unusual, unless your name is Tom Jones and you're singing, I have taken that word out of my vernacular for a myriad of reasons, none of which I will mention here, but the astute viewer will understand it, I'm sure, intuitively. But that's it for Market Call today. Today is Thursday, which means Dan Nathan is probably going out, which means he'll probably run into EY from SoFi at some establishment later on, which is fun.
Yeah.
I won't be there.
You will not.
I will not, because I'm rarely invited. That's it for Market Call. And I do dig EY from SoFi. And when Dan says LY, it's because he's just trying. Find your own nickname, okay? Glom onto something else.
I'm trolling. It's kind of like me adding you, on the Twitter, but which neither one of us might be spending too much more time on the Twitter in the coming days. Who knows? Let's see what happens here, guy, with the Twitter.
We'll see what happens with that.
I don't know. All right, let's take us out here. We got to get out of here, right?
He, too, has a proprietary platform, as it turns out. I want to thank our sponsors, FactSet, SoFi. I love just saying, get your money right all in one app. I think that's a great slogan. And I want to thank our production partners, Open Exchange. Check this out, peeps. Tomorrow, special Market Call, because why not? 11 a.m. with who? Carter Braxton Worth. That's what I'm talking about, people. Later.